What if you walked in knowing exactly what to say, how to answer, and how to impress from the very first question to the last? Your dream job is Mord's. Every year, thousands of candidates walk into a financial analyst interview and walk right back out without the job. Not because they were not smart kind, but because nobody told them what interviewers are asexually looking for. But what if you walked in knowing exactly what to say, how to answer, and how to impress FIME? From the very first question to the last? In my full video, I cover every single question, every answer, every trick that top them. Your dream job is one video away. Watch the full video right now and walk into that interview room.
So hi everyone, today we will be mainly discussing the conceptual interview questions, nothing but the application based interview questions for financial analyst job role. It means what kind of application based questions we can expect for this particular financial analyst job role that we will be discussing in this particular video. So I want everyone to please focus on this particular video. So definitely you will be getting some insightful inputs, and you can use these particular insightful inputs, and accordingly you can prepare for this particular financial analyst job interview. Normally, as most of you might be knowing, the most common question, why you want to become a financial analyst? So what is the main objective, why you want to become a financial analyst? So if you can see the slide, what kind of answer you can, because most of the students generally you will be having a confusion when this particular question is asked, why do you want to become a financial analyst, and what kind of answer you need to give. So for that you can say that passion, you are having passion for finance and data analysis, and you can also say that you have interest in decision making and business insights, and you can also mention that you are having strong analytical mindsets. Then the next question can be, what are the key responsibilities of financial analyst? So normally the key responsibilities of the financial analyst is to build a financial model, budgeting and forecasting, data analysis, reporting to management. So the major key responsibilities is to build a financial model. So as per your client requirement, you are expected to build a financial model. And generally financial analyst plays a major role in budgeting and forecasting and data analysis. Then if you see some of the most important and key application based question for this particular financial analyst job role is revenue analysis. Now what we did for the later part of this particular video is I just divided gave one moderate question relating to this topic and one difficult question related to this. So normally if you see the moderate question, suppose if there is a question, if the company revenue increases by 20% but profit decreased, so what kind of question we can expect here? So a company revenue increased by 20% but unfortunately the company profit decreased. So what are the reasons? So generally what are the major reasons for this? It can be like increase in the cost of goods sold. If a company cost of goods sold increases, or if the company operating expenses increases, there is a possibility that the company profit might decrease in spite of increase in the revenue. Then the pricing pressure which the company intentionally reduces the margin. Pricing pressure means if the company is dealing with a product which is having a huge competition, now in that particular case the company forced to cut down their prices, so definitely the margin will also decrease. Then higher marketing and expansion cost. So most of the companies nowadays generally what they are doing is they are incurring significant cost for marketing and expansion. So these are some of the reasons why the company profit declines in spite of revenue. Now if you see a difficult question on revenue analysis, now suppose if you see a question, how do you identify cost structure versus pricing strategy issue? So normally in that case what you need to do, you need to analyze the gross margin versus operating margin. Then you need to compare the historical cost trends. So what is the movement of this particular cost? So if you take 5 years past data, so during this particular 5 years how this company cost increase, decrease, and you also expected to do the perform a segment wise profitability analysis. If the company is dealing with multiple segments, then you are required to do a segment-wise profitability analysis. So these are certain things which you can use while framing the answer when there is a question on how to identify the cost structure versus pricing strategy issues. Normally, what is this cost structure analysis? So the moderate question on this particular how would you reduce company cost without affecting the revenue? So normally, if this particular question is asked in the interview, how you will reduce a company cost without affecting revenue? So in that case, the major elements which you need to put in your answer is identify non-value added cost, then optimize procurement, and improve operational efficiency. So if you can include these three in your answer, then definitely you can give the expected answer of your interview. Then if you see the difficult question from this cost structure analysis, so like how do you differentiate between fixed and variable cost and impact during the cost reduction? Nothing but when the company is planning to go for a cost reduction, how the fixed and variable cost is going to impact. Now in that case, how you can frame your answer? Now you need to analyze the cost behavior with output changes. Normally, let us assume that a company initially their output was 1000 units. Now the company want to either decrease or increase the output. So whenever there is a change in the output, how the cost is behaving, then you can also use the contribution margin analysis in order to know this particular effect, and we will be generally using the scenario modeling. So yours, if you can use these three key elements when this kind of question is asked, then definitely you can create a positive impression during the interview. Then second, profitability analysis. Now the moderate question on profitability analysis is which metrics generally used to assess the profitability. So the most common metrics we generally use: net profit margin, operating margin, and EBITDA margin. So I hope everyone knows EBITDA is nothing but earning before interest, tax, depreciation, and amortization. So the difficult question on profitability analysis can be, how would you improve the profitability of a declining business unit? So normally if there is a declining business unit, how would you improve the profitability of that particular declining business unit? So the common elements which you can include while answering this kind of question is generally you are required to identify the loss making segments, because if the company is having multiple segments, so which segments generally making the loss? So you need to identify the loss making segments. Then optimize pricing or discontinue products. So normally the loss making segments, in that case they may be you may be required to decrease the profit, or if there is no other option, you may be required to discontinue the product also, and improve the cost efficiency. So these are the certain key elements which we can use for these kind of questions. When it comes to working capital management, so a moderate question on this particular is, what does negative working capital indicate? What do you mean by negative working capital? How exactly what it indicates? So generally, possible liquidity risk. If a company is having negative working capital, it means that possible liquidity risk. Then efficient operations in some industries like retail. So there might be a possible liquidity risk or efficient operations in some industries like retail. Then the difficult question relating to working capital management. How would you improve working capital cycle? So I hope everyone knows working capital cycle. We can also say it as operating cycle. So the most common ways to reduce this particular working capital cycle is reduce the receivable days, optimize inventory turnover, extend payables strategically. So these three are certain strategies which we can use to improve the working capital cycle. Then if you see the another concept like budget versus actual analysis. So the moderate question on this is, what is variance analysis? Variance analysis in simple terms, comparing actual versus budget. Then identifying the deviations. And the difficult question on this particular topic, how would you explain unfavorable variance to the management? Suppose if the company is having unfavorable variances, nothing but adverse variances. So how you will explain this to your company? Now break into, now in that particular case, what you are expected to do, first you need to segregate that price variance, cost variance, volume variance, and you should also expected to identify the root cause. We generally say it as root cause analysis. What is the major reason for this particular variance? Suppose example, normally if you take material variances. Now in case of material price variance, let us assume that material price variance of a company is adverse. Now try to identify the root cause why the company material price variance is adverse. So it might be, you can say that you are trying to pay higher price to the suppliers of material compared to your standard price. It means you may not be having an efficient or effective bargaining strategy, right? So this can be something like a root cause analysis, and you should also be expected to suggest a corrective action plan for these adverse variances. Then the next topic connected with the financial analyst job role is financial modeling, because generally it is expected that every financial analyst need to master the skill of financial modeling. So the moderate question on financial modeling: what are the key components of financial model? So generally the key components are revenue drivers, cost assumptions, and forecasting. So how you assume the cost, what are your key revenue drivers, and which models you generally use to forecast the cash flows. And the difficult question: how would you build three statement model? So normally how this particular three statement model is done: first we'll link the income statement, balance sheet, and cash flow. You need to ensure the consistency, and the most important thing is whatever assumptions which you are considering, you need to validate those assumptions. Investment decisions. So the moderate question on this particular investment decision is: what factors do you consider before investing? Now normally as a normal lay person also, what are the major factors you do consider before investing? The common factors are the return which you are expecting, nothing but expected return, and how much return, how much risk is involved in that, and how effectively that particular investment is generating the cash. So these are some of the three common factors which you look into before investing. The difficult question is how would you compare two projects with different cash flows? So normally whenever two projects are there with different cash flows, normally we use the net present value, and we will also be using the internal rate of return, and always it is suggested to use a risk adjusted return when you are comparing two projects with two different cash flows. Then NPV analysis. So the moderate question on NPV analysis: what do you mean by NPV? So this is what does positive NPV means? So normally if a project is giving positive NPV, what does it mean? We assume that the project is viable, the project is feasible. So nothing but the project is profitable, and definitely we assume that this project is going to add value to the business. Nothing but it will help the business to maximize their wealth, or it will maximize the firm's value. So the difficult question is: how does change in discount rate affect the net present value? This is very important for this particular job role. Viewers, you need to understand this. How does change in discount rate affect net present value? So always do remember, whenever the higher rate, so the lower NPV. If the discount rate is high, definitely the NPV value will be lower. The higher the, suppose example, if you take discount rate at the rate of 20%, then let us assume that your NPV will be around 100. And if you take the discount rate at the 8%, then definitely we can expect the NPV more than 100. So always do remember, the higher the discount rate, the lower NPV. And in this particular case, we need to use the sensitivity analysis also. It means how sensitive the cash flows are. Then IRR decision making. The moderate question is what is IRR used for? Normally we use the internal rate of return for investment evaluations. And what are the major limitations of IRR? This is very important. The major limitations are multiple IRRs, and it might give some misleading results for non-conventional cash flows. So these two can be considered as one of the major limitations of internal rate of return. Now the ratio analysis. So the moderate question on ratio analysis, which ratio measures the liquidity? So the most common two ratios which measures the liquidity is current ratio and quick ratio. The difficult question, how would you analyze declining return on equity? So normally we will be using DuPont analysis, and we will be analyzing by using by identifying certain drivers like margin, turnover, leverage. Then scenario analysis. Now what exactly the scenario analysis means? So in simple terms, scenario analysis is nothing but evaluating different business situations. So what will be the company revenue when the business is favorable? What will be the company revenue when the business is adverse? So we will be evaluating the performance of a business with the different business situations. Now, sorry, a difficult question. How would you perform a stress testing? So we generally perform the stress testing by changing the key assumptions. The very important, the most common thing which we use is by changing the key assumptions and by evaluating the downside risk. So forecasting. So the moderate question on forecasting is how do you forecast revenue? So normally the revenue is generally forecasted by historical trends and growth assumptions. And how would you forecast in uncertain markets? Normally it is very challenging to forecast the cash flows or revenue during the uncertain market. So in that case, always the best thing what you need to do is use the multiple scenarios and the sensitivity analysis. Then if you see the industry analysis part, why is industry analysis important? Always it is better to know your competitor. Always it is better to know your industry. Always it is better to understand the market trends. And how would you evaluate the industry attractiveness? So the most common thing which we use is Porter's 5 force model, growth potential and profitability. Risk analysis, what exactly financial risk means? So risk of loss due to financial decisions. Whatever the risk of loss the company is expecting due to financial decisions. Suppose example, a company going with project A instead of project B. So what happens if the project A gives less returns compared to the project B returns? This kind of loss is nothing but financial loss. And how would you quantify risk? Now, normally the risk can be quantified by using standard deviation and value at risk. Then valuation. So the common moderate question on valuation is, what is company valuation? So company valuation is nothing but, in simple terms, estimating the company worth. What is the true worth of a company? So what we nowadays the most common, the better strategy to value the company is its prospective cash flows. How a company can generate the cash flows in future. Now, how do you value a company? As I mentioned, normally we'll be using the DCF. DCF is considered as one of the most important method to value the business, discounted cash flow method. So we will be discounting to the present value of the prospective cash flows. Suppose if the company is expecting to generate cash for the next 10 years, so we'll be converting these 10 years cash into the present value. And we'll be using the comparable company analysis also for business valuation. Then the capital structure, the moderate question, what is capital structure? Capital structure is nothing but mix of equity and debt. And the difficult question on this, how does leverage impact the profitability? This is a very important question. Normally, how this leverage impact the profitability? It generally increases the return but also risk. It means there is an increase in return as well as increase in risk. So there might be some questions on Excel in finance. So why this particular Excel is important? Normally financial analysts are expected to build a financial model, and financial analyst is expected to do some data analysis. So Excel is a right platform to do such kind of things. And the next question can be from related to Excel is, which advanced Excel tools generally it is preferable for a financial analyst to use? Normally like pivot tables, macros and what if analysis. These are certain advanced Excel tools which will be used by the financial analyst. Then business decision making. How does a financial analyst support decisions? Always the financial analyst support decisions by the data driven insights. And how would you advise management on expansion? So normally when a company want to go for an expansion, normally we need to do as a financial analyst risk return analysis, and we should also do a feasible financial feasibility. Then case, suppose if you say a company's sales are rising but the cash is falling, because you can also expect a real case scenario, also scenario based questions also in the interviews. Suppose if you see a sample question like company sales are rising but the cash is falling, why? So in that case the answer can be because of high receivables, because the company major portion of the sales is credit sales and their receivables increased significantly, and the another reason might be the inventory buildup. Now what steps would you take to fix it? Now in that case, high receivables and inventory buildup, what steps can be done? The most common thing is you need to improve your collection cycle by having an effective credit collection strategy, and try to optimize the inventory, and always it is suggestible to control your expenses. So the strategy which we can use for high receivables and inventory buildup is improve collection cycle, optimize inventory, and control expenses.
Subscribe to Account Finance with Ravi for finance and accounting insights.